Now today we're going to have this heart-to-heart sharing because we've all been seeing so many advertisements on do not buy low, sell high, or buy low, sell high is bad advice. Yada, and I don't quite understand what's the big hoo-ha about this buy low, sell high thing. Because quite simply, buy low, sell high is just a mathematical formula on how to make profits, correct? It's like you need to buy and you need to sell it at a price that's higher to make profit. Or you need to buy the price that's lower than what you sell. This is math. This is not even advice. But today you're going to hear things on how you can actually improve your own investment approach. Because I have some solid material for you. And before we get there, smash on like button. No, what are lows not to buy? I want to give you some context also because they say do not buy low, correct? I have a few things for you to understand. Let me pull up this chart for you to see. What do you realize? There are a few event-based market crashes, correct? Let me circle out for you. September 11 attack on US World Trade Center. That was a period whereby the world was concerned about terrorists. SARS, COVID-19 in 2020. These are actually event-based market crashes. And quite simply, event-based market crashes are actually a more simple time to start buying. Because quite simply, you should always trust humanity. We can always recover from these shocks. Typically, they are not long-lasting. Then what about, general economic news? Because over there, you could still see further information. Chinese-led global slowdown 2016. I'd like to throw in a few other general economic news that has weakened the market, such as Fed tapering, such as interest rate possibly rising. These are noise. Filter all this inflation talk and stuff because nobody knows where interest rates are going. This is all noise that confuse you. If markets come down because of it, it's actually quite simply a time to buy. What about for real market crashes? Look at this. .com crash in 2000. And what about this? Global financial crisis 2017, 2007, 2008. These are times that are also to buy but not easy. Quite simply because the damage is widespread. The damage is long lasting. Global financial crisis lasted more than a year. Now, don't also have that perception that when we have this kind of crashes, you can ride into the market like a white knight. Use your cash, buy up, profit from other people. That is not a good, humble approach to things. Because quite simply, at that point of time when market crash, you see news everywhere. It's bad. Blood is everywhere. You have friends telling you, I've been shorting the market and making money. I sold out thankfully, and you'll be holding on to what you already invested and looking really silly. So that is not easy to buy. Don't underestimate that period. I also have this belief. I don't know if you've heard before my sharing or not. If not, maybe let me explain how I approach the markets. Porters, when they help hikers go up to Mount Everest, it's a dangerous trip, correct? Some of these porters are very experienced. They've been on a mountain, came down at least 10 times. But what do you realize? Before every trip up, they pray to the mountains. They respect the mountains. Every trip up is just simply to feed their families. Go up, do the job. Don't be complacent. Don't fool around. Come down safely. Same thing. When I approach the investment markets, it's the same thing. It's not about going up there to brag. It's about going there, get the returns, come back to feed the family. The day that you lose respect for the mountain, which is the market, is the day you see an avalanche. So don't be overconfident, especially if 2020, you've seen some gains. Don't be overconfident because avalanches happen. They can bury any experienced hiker at any time. So that's the message I'd like to share with you. Now let's get back to more serious parts. What are lows not to buy? Because we talk about what are lows that can be bought, correct? Again, let me pull up SPH. I don't have a personal agenda against SPH. I don't know why I keep kind of saying them in negative light. But I think they are very good case study learning points. Let's look at SPH back in 2010 to 2015. What do you realize? They hover around $4 per share, correct? And if we fast forward to 2007, 2008, SPH actually came down with the market together. And let me reiterate, SPH in 2008 in the market crash where it came down from $4 to $2.50 is actually a buy. Why? Because if you think back then, everybody was still reading newspapers almost for all their media information. And SPH was still rolling in profits. Whether advertisers were cutting back budgets or not, people were still buying newspapers in any case. So SPH was still a highly profitable, highly monopolized business. And any point at a time where it came down in price was actually a good time to buy. The business was intact, you realize? So regardless of what's going to happen with banks, SPH business was never going to be affected. But if you fast forward to 2000, 2018, SPH price came down, correct? That is actually a time not to buy. Why? Because the business of SPH has deteriorated. The media business is being attacked by internet alternatives, and that movement is long lasting. It's not going to be a temporary thing, it's a long lasting thing. Therefore, that buy on the way down is actually a bad idea. You're kind of catching a falling knife. And regardless of that bounce up quite recently, I still think SPH is still lacking investment merits, at least to my eyes. So let's just explain what are lows not to buy. Having said all the lows part, let's talk about the highs, because buy low, sell high, correct? So really, let's address the high, because that is investment principles you should hear also. What are highs not to sell into? Let me ask you this question. Do you always sell out your positions to take profits? Because if you have, you realize that your investment total return is actually quite poor, correct? Because every time you go up, you cash out. Every time it comes down, you hold on to losses. You make small profits and you have huge unrealized losses. That is a habit you need to change if you want to be a successful investor. When things go up, you may not need to take profit. Now let me share with you an example. I'm a big fan of PropNex, correct? In my private channel, if you're keen, I've actually further investment analysis over there. So look for join buttons below. It'll give you more investment tutorials. So very important, PropNex. I'm a big fan of it. And what have I actually shared before? It's one of my biggest holdings. And if it has gone up by a bit and I sold, then you realize that I will have made very little profits. But as of last year till now, I've actually kept these positions and rode up the wave. And you realize that when you ride up a wave fully, you make 1 times more, 2 times more quite easily on your capital. That is how actually investment gains are actually made. Big investment gains to cover for small investment losses. That is the real juice of how anyone can invest properly. And that's something for you to consider. And also, when are times to sell, even for PropNex, you should know also that anyone in the property business, whether it's the agency or whether it's a developer, property is a market cycle, which means there will be feast and famine periods. When feasting portion is at the peak, there's a time to be savvy and start to sell. Cyclical companies also apply to, for example, palm oil, in which Singapore we have a lot of listed companies, and semicon industries. In Singapore, we also have a lot of listed companies. So again, these are cyclical businesses, which means you need to be very familiar with the industry to get involved. Now also, when are highs to sell into? I'd like to address that also. That is actually when the business has deteriorated. Now let me pull up some examples for you to see. Again, SIA. SIA's business was picking up, but then the business has deteriorated because of the circumstance. So once you realize business is deteriorating or fundamentally changed, permanently damaged, that is possibly a high that you need to consider selling into. So really this has given you a broad perspective. But let me give you another alternative that's way simpler, which is if you buy broad base, you buy the index or you buy funds that are diversified, do you realize that you don't make decisions on the business? It's much simpler, correct? Which means when you buy broad base, you don't decide when to sell specifically. Markets go up, you buy less. Markets come down, that's a time to buy more because you're only buying general market movement. Much more simple approach. And that's actually how I build private clients' portfolios. So if you're keen to do proper portfolio building, look for my links below. I'll be keen to share with you one-to-one basis. And in my private clients portfolio, I've actually seen 30% gains, 70% gains, or even 110% gains in certain funds, and there was just no need to sell them out. Simply because market moves up again, it's time to buy less. Markets come down, it's time to buy more, or do rebalancing with market conditions. So this is actually how portfolios can actually be a very much simpler approach to investing. So hopefully I've covered things well. If you have benefited, smash the like button. And I've actually a previous video I'd like to introduce you to, which is when to buy. So if you're curious, how to improve your financial journey or investment journey, look for that tutorial. It'll explain to you better when to buy. And I'll sign off from here and see you there. Take care and goodbye.